As of Tuesday, August 4th, 2026, the regular United States stock market session is currently closed ahead of the opening bell, with Super Microcomputer Inc. trading under the Nasdaq ticker symbol SMCI, wrapping up its most recent official trading session at $28.64 per share, representing a daily gain of 2.57% or 74 cents, while pre-market indications are hovering around $29.21 per share. While retail forums across social media and financial feeds on the Robinhood app celebrate every green candle as the start of an unstoppable structural rally, institutional desks across Wall Street are playing a far quieter, more calculated game. Most individual traders looking at Super Microcomputer Inc. see a high-octane hardware supplier bouncing off its 52-week lows near $19.49, expecting a smooth return toward its historical peak levels. But the cold reality beneath the order books is that Super Microcomputer Inc. is caught in an intense tug-of-war between soaring top-line revenue growth projections and shrinking gross profit margins, all while operating under the heavy shadow of its upcoming August 11, 2026 earnings report. Over the past 30 trading days, shares of Super Microcomputer Inc. have experienced dramatic volatility, swinging from mid-$20 troughs up to $31 before settling in its current sub-$30 range. If you open your individual brokerage app on Interactive Brokers or check Interactive Brokers trading volumes, you will notice that trading activity has seen sharp, localized spikes on days when broader technology sector sentiment shifts. Institutional investors are watching every tick closely on Interactive Brokers' platform, comparing the performance of Super Microcomputer Inc. to high-flying semiconductor anchors like NVIDIA stock. While NVIDIA stock continues to command premium valuations due to its proprietary architecture, Super Microcomputer Inc. operates in the server assembly and rack infrastructure layer, where competition from legacy IT giants is fierce and pricing power is far more fragile. When traders log on to the Robinhood stock trading interface or manage their holdings through SoFi Active Investing, the immediate tendency is to treat Super Microcomputer Inc. as a direct proxy for artificial intelligence computing expansion. Yet looking at recent trading activity across major investing sites, the stock has repeatedly failed to sustain breakout levels above $30, signaling that large asset managers on Fidelity Trading Platform and Schwab Intelligent Portfolios are using short-term price spikes to rebalance their exposure rather than building aggressive new long positions. Wall Street analysts expect Super Microcomputer Inc. to post quarterly revenue of $11 billion for the upcoming earnings disclosure on August 11, 2026, which would mark an astonishing 91% increase compared to the same period last year. On paper, that headline figure looks like a dream for anyone participating in self-investing or using online investing tools to construct an aggressive portfolio. However, Wall Street expectation frequently diverges from operational reality when it comes to bottom-line profitability. Consensus estimates put earnings per share at 68 cents, but the key metric institutional desks using Fidelity Wealth Management and Fidelity brokerage accounts are dissecting is gross margin compression. In recent fiscal quarters, Super Microcomputer Inc. saw its gross margins contract as liquid cooling infrastructure and massive rack-scale server deployments required heavy upfront capital expenditure and aggressive pricing to capture market share. Investors utilizing SoFi Invest, SoFi Stocks, or SoFi ETFs for online investment must realize that growing top-line revenue at 90% means very little if cost of goods sold eats away at net profit margins. When hedge funds execute trades on Interactive Brokers account software, they analyze whether Super Microcomputer Inc. can regain pricing power against rival system builders, or if its margin profile will remain under permanent structural pressure. The broader macroeconomic backdrop adds another layer of friction for retail traders managing their accounts via the Fidelity mobile app or searching for investment help across individual brokerage communities. Elevated interest rates have kept corporate borrowing costs high, forcing enterprise technology departments to evaluate their hardware architecture purchases with extreme scrutiny. While massive hyperscalers continue to order high-density server racks packed with advanced direct-to-chip liquid cooling systems, mid-tier enterprise buyers are stretching out their server replacement cycles. For investors using intelligent portfolio algorithms or setting up automated recurring purchases through Fidelity IRAs, this macro drag creates uneven order flow month after month. During recent trading sessions, options flow for Supermicro Computer Inc. showed notable activity in out-of-the-money call and put contracts, indicating that sophisticated derivative traders using Interactive Brokers stock trading tools are hedging for a massive post-earnings volatility spike. Retail buyers placing fractional orders on Robinhood fractional shares or managing cash balances via Robinhood Cash Management might view the stock's recent rebound as an easy entry point, but institutional order flow suggests extreme caution until management offers clear guidance on forward margin trajectories, component availability, and supply chain lead times. Comment below how many shares of Supermicro Computer Inc. you currently hold in your portfolio and whether you are buying this pullback or staying on the sidelines. To understand why Supermicro Computer Inc. attracts such fierce debate among retail traders on the Robinhood Investments platform and institutional managers utilizing Fidelity Investments, one must look closely at its core business model. Supermicro Computer Inc. specializes in high-performance server solutions, building modular compute architectures, storage systems, and advanced direct-to-chip liquid cooling technology for enterprise data centers, cloud providers, and artificial intelligence clusters. Unlike traditional hardware vendors that offer rigid server configurations, Supermicro Computer Inc. uses a building block architecture that allows clients to quickly customize server racks according to specific computational workloads. This agility enabled the company to move rapidly when global demand for high-density compute infrastructure accelerated, positioning itself as a primary integration partner for high-power hardware setups alongside major technology ecosystems like Tesla stock and Apple stock in large-scale data center deployments. However, assembling servers packed with high-demand graphics processors requires massive working capital, delicate inventory management, and thin margin execution, which makes the financial profile of Supermicro Computer Inc. vastly different from asset-light software firms or specialized semiconductor designers. Looking back over past financial reporting cycles, Supermicro Computer Inc. demonstrated extraordinary top-line expansion, surging from a specialized hardware builder into a multi-billion-dollar infrastructure player. Yet historical financial statements reveal the underlying capital intensity required to sustain that rapid pace of expansion. Operating cash flows have periodically dipped into heavy negative territory during aggressive build-out cycles as capital became locked up in inventory and component procurement. For self-investing enthusiasts tracking equities through SoFi Robo-Advisor or analyzing Interactive Brokers' fee schedules, this cash flow drag is a critical detail that headline revenue growth often masks. When component costs rise or customer payment terms stretch out, balance sheet cash balances face real operational strain. Furthermore, past administrative delays in financial filings created significant headlines, driving sharp sell-offs that shaken retail confidence across major investing sites. While the company has taken deliberate steps to reinforce its internal controls, audit mechanisms, and corporate oversight to preserve its standing on major exchanges, risk managers overseeing Fidelity ETFs and Fidelity mutual funds maintain strict concentration limits when evaluating weightings for Supermicro Computer Inc. compared to established megacap balance sheets. Looking ahead into the remainder of 2026 and beyond, the future trajectory for Supermicro Computer Inc. depends entirely on whether market expectations can align with operational execution. The optimistic scenario relies on Supermicro Computer Inc. maintaining its technical head start in liquid cooling solutions as thermal output in next-generation server clusters increases beyond what traditional air cooling can handle. If management demonstrates during the upcoming August 11th earnings presentation that gross margins have found a firm floor and that complex liquid-cooled rack deployments command higher profit margins, the stock could retest major resistance levels well above $35. Conversely, the realistic risk scenario involves persistent margin pressure driven by aggressive discounting from large enterprise server rivals, along with potential supply delays for specialized liquid cooling components, power distribution units, and high-bandwidth memory modules. Investors constructing long-term allocations through Schwab Intelligent Portfolios or managing tactical momentum positions via SoFi trading platform must carefully evaluate these contrasting potential paths. If hardware margins remain trapped in single-digit territory, price-to-earnings multiples will likely face downward valuation compression, regardless of how impressive the headline revenue figures appear. In closing, Supermicro Computer Inc. presents one of the most compelling expectation versus